Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. Today I've got 7 GARP stocks, and if you're not familiar with the acronym, GARP stands for Growth at a Reasonable Price. And today we have 7 GARP stocks that are trading right around their 52-week low. And I've got to say, as I was going through this list of 7 stocks, it's really surprising how far a lot of these names have fallen. I get the reason that they've fallen from their COVID highs. Obviously, we were in insane valuation territory in 2021, but now we're starting to get to a point where the fundamentals are looking absolutely outstanding. And if your investing horizon is, 2 to 5 years, perhaps even longer, you're starting to play the odds very, very favorably with some of these big brands we have here. So let's jump into the list. First stock on the board today is the Walt Disney Company, obviously one of the biggest brands in the entire world, currently trading at $123.12. Take a quick look at our fundamentals here. See the 52-week range, 123.10 was the lowest before I refresh the screen. Now you're down to 123.04. And you've got an EPS of $4.45, and you've got a P ratio of 28.01. So when we think about the reasonable price, right, the reasonable valuation, I think Disney certainly fits the bill when you have a forward PE under 30, assuming, of course, that you do have growth on both the top and bottom line. So let's check that out. All right, so now we're on the growth tab for the Disney Company, and this is available on all the stock pages on Seeking Alpha. Quick pause too, if you're interested in learning more about the Seeking Alpha platform that I use on this channel all the time. My affiliate link is in the description, and when you click on that link, you instantly receive a 50% off discount for a 1-year subscription to their premium service, which is what I'm using here today. Now, what we have on this page is sort of 2 different types of metrics. We have rear view mirror stuff, year over year, trailing 12 months. But we're going to focus on the other side, which is forward, right? We're always looking ahead. These stocks have downward momentum, so let's just make sure that the forward picture is still bright. So we'll scroll down here. We got revenue growth forward. These letter grades, in case you're curious, these are sector relative grades that are assigned by the Seeking Alpha quant formula. And this can be helpful for a quick scan without having to go through all the numbers, but let's go through the numbers here. Like I said, revenue growth forward, plus about 13% for Disney. EBITDA growth forward, plus 15%. EPS diluted growth, plus 40%. For Disney. How about free cash flow per share looking ahead? Plus 25% for Disney. So I think we nailed the formula here. We want growth, which we're clearly seeing on this page, and we want reasonable price, which we talked about the forward PE for this one. I like where Disney sits right now, certainly as a long-term investment. All right, next on the board is the latest member of the Low Momentum Misery Club, and that is Netflix. Just had a tough earnings call a couple days ago. Current price is $216.71. The 52-week range was $211.52, so just a couple bucks above that right now. Our EPS forward, the projected EPS is almost $11. And our forward PE is 20.62. So definitely a reasonable price. Now you might be thinking there's no way that Netflix is growing. I just read the headline that they lost users. And that is true on the user metrics. But when it comes down to just straight business metrics, aka revenue and profitability, we're going to see that Netflix has plenty of growth ahead of it. All right, here we are on the growth tab for Netflix. Revenue growth forward, plus 12.74%. EBITDA growth, plus basically 17%. EPS diluted growth forward, plus 27%. And free cash flow share growth, plus 6.49%. So keep in mind with Netflix, even though they did take a hit on the user front, they also bumped up subscription fees a little bit, and they're going to start eliminating some of the free users, possibly adding an ad-supported tier as well. In fact, I think they've all but confirmed that. So when you talk about business growth, you're usually talking about revenue and profits. And both of those are checked off very well here with Netflix. Double digits on both the top and bottom line looking ahead for this year. All right, how about Facebook/Meta coming in at 189.47? And you can see their chart. They've had their share of user growth problems as well. EPS is now $12. $12.21 is the projection for this year. Forward PE of 16.42. That's 16.42. So the reasonable price here, I think, is very safe to say. But here again, this is another company that's losing users, right? Flat to negative on user growth. Well, how does that affect their top and bottom lines? We'll switch to the growth tab here, and revenue growth forward plus 21%. That's a good sign. EBITDA growth forward plus 15%. EPS diluted growth, looking ahead, 12.66%. And where's that free cash flow here? Plus 15% projected for this year. So I don't know if we're ever going to see this on Wall Street where we get off of this user growth fascination. User growth is important, right? It helps build the long-term life cycle of a platform. But on the flip side, just from a straight business accounting standpoint, you can grow revenue and you can grow profits with flatline user growth. And let's be honest, for all these companies that are facing user growth problems, they're probably one or two features away from drawing in a whole new section of users, and you just never know if they make an acquisition or they launch a new feature, how quickly that growth can resume. All right, next stock on the board is PayPal, coming in at 89.24. PayPal is a stock that I own, and I have watched as that ice cube has melted and melted and melted. So here we are today, under $90. This one has an EPS of 463 looking ahead, and a forward PE of 20.5 to be exact. All right, now how about our growth? PayPal doesn't score as well as those other stocks in terms of sector relative grade. They are sensitive to e-commerce a little bit, and there's obviously been a lot of downward projections there. But across the board, you're still winning with this one. Revenue growth forward, 17%, almost 18%. EBITDA growth, plus 15%. EPS diluted growth, plus 14.28%. And free cash flow per share growth, plus 17%. So across several metrics there, you got double-digit growth on both the top and bottom line. Fits very nicely in this GARP stock video. Next stock on the board is Starbucks, trading today at $79.39. Starbucks got another hit this week with rumors of unionization going on in the company. We'll have to see how that goes. And when we look at our fundamentals here, we've got a forward PE of 24.28, and we've got a forward EPS of $3.30 per share. All right, on the growth side, revenue growth forward, plus 14.93%. EBITDA growth forward, 31.77%. What else do we have? EPS diluted growth forward, almost 50% growth. Free cash flow per share, plus 234% growth projected for this year. And keep in mind, with Starbucks, 2021 was still a COVID impact year, right? Because the first portion of the year, and then probably also at the tail end, when some of the COVID lockdowns picked back up, you still haven't had a normal year for this company. And I'm not even sure that 2022 will qualify fully as 12 months of a full year because here, even in America, you had some closings in January, and then over in China, you have lockdowns galore. So if you're thinking long-term with an investment in Starbucks, I would say, I mean, you haven't even had the perfect year yet. And if you're lucky, you'll get that in 2023. But in the meantime, you're growing double digits top and bottom line. All right, next up is Salesforce, coming in under $180. Forward PE of $39.93. This is a slightly higher forward PE than we've seen with the other companies, and that's because the growth rate's a little higher. So we'll look at that here in a second. You do have an EPS of $4.66 per share. All right, now about that growth rate. So you see revenue growth looking forward plus 21%. Most of our other companies were in the teens, the 10s to the teens. And now that we're talking about Salesforce, you're in that 20% growth range, and that demands a higher multiple typically in the market. EBITDA growth, plus 12%. EPS diluted growth, plus 5%. So this is something here that's probably the weaker part of the equation for Salesforce. You're going to have a company that grows revenue much higher, but you can see the full trickle-down effect to the bottom line. There's a lot of costs that hit it first, but still 5% growth on the EPS line, still not bad. And then if we get into free cash flow per share, plus 25% growth expected for this year. All right, our seventh and final stock today, Align Technology, under $400, $385.75. This is the maker of Invisalign braces, and Align has a fantastic track record of growth on both the top and bottom lines. Let's start with our valuation though. Forward PE of $32.85 and our EPS of $12.76 per share. Switching over to the growth tab, revenue growth plus 32%, basically 33% projected for this year. EBITDA growth looking forward, plus 42%. EPS diluted growth, plus 44% for Align. And free cash flow per share, plus 28% growth. So if we go back to that first page, forward PE of 39, I think that's the highest out of all 7 stocks that are featured here, but you get the gist on why that would be. It's hard to imagine that this one falls much lower than that, but regardless, if they continue to compound their victories as they have for the last several years, this could be a great stock for a long-term investment. All right, guys, so those are 7 GARP stocks at or very near their 52-week lows. And keep in mind, those were some large cap, mega cap companies we were looking at there. All of them have EPS. All of them have free cash flow. These are not fly-by-night penny stocks. So there's a little something in there for everybody if you were to ask me. If you don't like the FANG names, you know, you've got the Align Technologies, you've got the Starbucks, just a lot of deals that are becoming available right now. But as always with a list like this, I do this to give you research ideas. Make sure you keep the ball rolling with a platform like Seeking Alpha. Dig a little deeper, see what you like and dislike about a company before you jump in. Okay, don't forget to give this video a thumbs up if you enjoyed the content. I really appreciate it. Also check out that Seeking Alpha special offer down below. Hope you guys enjoyed this. We'll see you on the next video.